Welcome back to another episode of Pure Perspectives. I'm Clark Alexander. I'm sitting down with Gary Pierce down in Texas, and we're going to talk about the three things you need to be aware of in the market. Before I talk about those, just a reminder, give us a like, give us a subscribe, leave us a comment. We really appreciate all your support. The three things we're going to talk about today, existing home market, economic indicators you need to be aware of, and then obviously the big one, at the very end, we'll talk about mortgage rates, what's going on in the market. So we're going to discuss all those points. We appreciate your support. Let's get started right now. The three things that we're going to cover today in order, so we want you to stick around. Number three is going to be the existing home market. What's going on? What are the trends we're seeing? Why that's important? Number two is just economic indicators, right? We talk about them. What really drives interest rate movement? We're going to talk about what the indicators are, what's coming, what we're looking out for, and then obviously that ties into mortgage rates, the big one, what we're seeing, what we're expecting, and why the market is the way it is. Does that sound like a good set of three to start off with, Gary?
Let her rip.
All right, let's go. So number three, the existing home market. This is a topic that's getting more and more coverage in the press because for the longest time all we've heard is there's a housing shortage. Certainly not the case. What's the read now?
Yeah, I think so. Sellers are kind of getting frustrated in the market. What we're seeing is home values are starting to slip a little bit, and the expectation of sellers are not in line with what buyers are willing to do given the elevated cost of home ownership, whether it's mortgage rates, insurance costs, taxes, whatever that may be. So those are the biggest things. So sellers are getting they're becoming more frustrated. Buyers are trying to find the right deal, which is harder to do because of the overinflated potential seller expectation. So that's the biggest thing I think we're seeing and from a current market perspective.
Yeah, I would say, I'm up here in Northern California. It's been a hot market for, it feels like as long as I've lived here. Realtors are now having conversations with sellers and preparing them like this might take longer than you expect. Like don't let past indicators or past transaction times like get in your head. This could take a little bit longer and by longer we're not talking months. It's a matter of it could take some weeks, but there's definitely more inventory, seeing more homes sit on the market. I think last time I checked there's over 500,000 homes for sale, not enough buyers in the country. So it's definitely, the tone has changed for sure in the last 100%. Month or two.
Yeah, absolutely.
So economic indicators. So what are we on the lookout for? What do we think is going to be the needle mover with everything going on in the tariff discussion? It seems to be an extra level of noise that's impacting what the economic indicators would normally tell us is going to happen. What's your read on what's going on now?
Yeah, I mean the tariffs are the overarching kind of macro conversation that have kept rates kind of elevated. If you go back 60 to 90 days, we're probably, if you watch some of our other videos, I talked about rates. We were, 6.599 were in play. Today, that's not the case. You're still in that 6.75 range. So, the tariffs are there, inflation, obviously those are kind of hand in hand. Most of the news media and a lot of economists feel like they are inflationary, but the other side of that coin is there's a ton of revenue being generated to offset a lot of that. So, this week, the administration announced multiple new trade deals, Japan being one of the bigger ones, with large investments coming into the U.S. for growth and investment in business here. So that's a good thing. Again, this is going to take some time for this to kind of work its way out. We need to see what this looks like. And so tariffs are the big thing. The typical stuff that we look at that drives, obviously GDP. The economy seems to be humming along pretty well. Generally speaking, inflation is continuing to work in a manner that is, a downward trend. So that's good. Being able to keep that that in check. So, as inflation comes down, the job market seems to be really strong. So all these measures, when you combine it, it just keeps us in a range, right?
Yep.
Like we're staying in that range. And so the big thing's going to be tomorrow when the Fed chair speaks. All indications are no rate cut tomorrow, right?
Hmm.
There's like a 4% chance of a rate cut. So don't really expect that. The most anticipated rate cut would be in September. There is no meeting next month with the Fed, so everybody's pointing to September and possibly another cut between September and the end of the year. So we could see as many as two, maybe three, probably two cuts. If everything lines out, the Fed, their hard stance, inflation has to
Yep.
be down. They're not gonna, they're not gonna make those cuts if inflation continues up, right? And so it is a unique time to cut rates in a market that is showing strong GDP, showing strong growth, showing a strong employment market. So this is a very unique situation that we're in right now, where you've got the administration and a lot of economists, a lot of the big folks on Wall Street are saying, "Hey, cut, cut, cut," and then the other hand saying, "No, we don't need to. We've got a strong economy. We've got a strong job market." So there's this huge tension between those two parties as to what that means, and then that obviously translates to mortgage rates staying in that range.
How much is how much is it the fear of delayed inflation from tariffs, right? Because it takes some while, as you mentioned, it takes some time for tariffs to impact the market, for that cost to trickle down to the consumer. Like, it's not instantaneous. It's not like you apply a tariff and suddenly prices
Yeah.
on goods go up. So how much, it feels like they're kind of hedging their bets here,
Yeah. Yeah. Yeah.
or their losses, if you will, and just
Yeah.
saying, hey, we don't know. It's great that we're getting these trade deal signs, but there's still others hanging out there. What's the impact on inflation of these tariff deals?
Yeah, and that's TBD, right?
Yeah.
So there's a couple things, right? Most folks think, an added cost trickle down to the client, to the consumer, right?
Yep.
Which is kind of a logical deal. The other side of that coin is, you look at a lot of these companies, if the tariffs are in a reasonable manner, they're going to do what they can do to absorb that cost and that pass that
Yep.
along to the client. So they're talking about that openly. I mean, the guys over at, I was watching the CEO from, what was it, Heineken,
Hmm.
and they feel like at 15%, they can absorb that and not pass that to the client or the end user.
Yep.
And so I think it's just going to be more time. And that's what Powell keeps talking about. He's like, "Hey, we need more time
Yep.
to figure this out." And so, we'll TBD on that. I mean, nobody has a crystal ball on how it's going to really impact everything, but we haven't seen the amount of, I guess, coverage to equate to higher inflation. We're not
Yep.
seeing an absorbent amount of inflation. We're not going from like 2.3 to 3.3 or 3.5 because of tariffs. It is just part of, things cost more. And, probably a whole nother conversation around inflation, that people need to understand that you need to have inflation at a reasonable manner
Yep.
every month, every year, to keep the growth going. You have negative inflation. That's a problem.
Yep.
That starts talking about recession. And so, a couple percent is the target for the Fed. And so if we stay at that, the GDP, the economy stays humming along, then they can start thinking about cuts.
Good stuff. All right. So existing home market, lots of homes in the market available,
Yep.
more homes than buyers, listings
Mm-hmm.
hanging around longer. Economic indicators, obviously, if inflation's the big topic,
Yep.
and then mortgage rates. It's kind of we're kind of in this.
Range.
We're hovering in this range. We bounce up, we down, and the
Mm-hmm.
press would lead you to believe these are massive swings. They're not massive swings. We're seeing just
Two,
the EKG, if you will, of mortgage rates over the last couple weeks.
There was more demand when rates were pushing 8,
Yeah.
I would say,
Yeah.
than there is today.
Yep.
So I think you look at that and you're like, hey, this is crazy. We're in a, you know, whether it's a 100 basis points, a 1 point drop from where we were 2 or 3 years ago when rates really spiked,
Yep.
and today where we're at it, call it 6.75, 6.875 ish for a conventional loan. So yeah, I just we're staying in that range, and if you look over the last 3 years, we had a couple spikes and a couple of drops, but in the main, for the last 3 years, we've kind of stayed in that
Yeah.
range.
Yep. All right. Good stuff. Those are the three things that we wanted to bring to your attention this week. We'll be back with another episode like this, keep you abreast of what's going on in the market. Gary, as always, thanks so much for taking the time. Happy
Yes,
house
sir.
hunting, everybody, and reach out if you have any questions. And a reminder, give us a like, give us a subscribe, leave us a comment. We'd really appreciate it. As always, we appreciate your support. We'll see you on the next one. See you, Gary.
See you.